Understanding pension plans. Learn how life insurance and a pension plan can increase annual retirement income and eliminate retirement death taxes. Presented by Bruce Kaufman, CLU CHFC. I'm a former Vice President, Insurance and Wealth Transfer Planning with Standard Federal Bank and ABN AMRO Bank. I'm a Wealth Transfer Specialist, formerly with JP Morgan Chase and Comerica Bank. I'm a Corporate Training Consultant, Financial and Wealth Planning with Alliance Inc. And I'm an Insurance Agency Owner, Bruce Kaufman Agency. One of the most complicated financial planning concepts is that of structuring a pension plan that takes advantage of current tax laws that greatly increase tax-deductible contributions over current 401k maximums, will guarantee a lifetime retirement income of over $200,000 per year, will provide approximately $2 million of tax-free life insurance at virtually no cost, will protect millions of dollars in client assets from judgment lawsuits for individuals who are in occupations that have high instances of legal attacks, such as property developers and certain types of medical professionals. Taxation of a retirement plan at death. Understanding effective tax rates. When a person dies with a substantial retirement plan asset, taxes are due from the beneficiary of the retirement plan due to established inherited IRA rules. For example, let's look at an 80-year-old with no marital deduction, with the current value of a retirement plan of $2.5 million. As you can see here, their effective tax rate for federal taxes is 35.6%. And you still have taxes for state taxes. Many states have various income tax rates. For example, in Michigan here, we're at 4%, but in California, you're at 13%. So you also have to account for your state income tax. Now, when you receive an IRA inheritance from a parent, grandparent, or other family member, you have three choices. Now, if you're not the spouse of the decedent, then the limited marital deduction is not available to defer the income tax. You can use a required minimum distribution schedule based on your life expectancy. We'll talk about that in a little bit. And if the decedent, person dying with the large retirement account balance that you're receiving, is under the age of 70.5, 70 and a half, you will need to take the entire amount in a lump sum by the end of year 5. Okay, let's take a look at option number 1. When you open up an inherited IRA, we're going to use a life expectancy method if account holder is over 70 and a half years of age. So if the person dies is over 70 and a half, you're going to utilize your life expectancy. You could do a RMD, required minimum distribution, over your life expectancy. So let's say you're 50, your life expectancy is 34 years, okay, age 84. The inherited IRA amount is $2.5 million, so your first year distribution must be $73,529. That's $2.5 million divided by 34 years. Your effective tax rate, let's say, is 20%. It's going to be less. So your net IRA distribution is $58,823. Now the problem here, you could save a tremendous amount in taxes, but most people, if they're going to receive $2.5 million, they'd rather have $2.5 million now to buy things than to receive $58,000 a year. So that's one of the issues because most people aren't used to receiving a large amount of money, especially over $1 million at one time. So option number 2 is we're going to open up an inherited IRA, but we're going to use the 5-year method. So if the original IRA holder died before the age of 70 and a half, the entire IRA needs to be distributed by the end of the 5th year. So your effective tax rate is going to be 40% in this scenario, like we talked about effective tax rates before. So you have an IRA balance of $2.5 million. So your total tax due, depending on what state you're living in, but let's state Michigan, for example, your total tax due in this scenario would be $1 million. Now option number 3 is just a lump sum. The beneficiaries just want their money now, immediate liquidation, and taxation at 40%. Now we're going to talk about whole life insurance and a retirement plan to pay for taxes. The purchase of life insurance must be incidental to the primary purpose of providing retirement benefits under the plan. Under Treasury regulations, this incidental benefit results in limits being placed on the amount of premiums paid as follows. Whole life insurance, the total premium cost is less than 50% of the total contributions, and we're going to go over this in detail in a little bit. We do not recommend universal, variable, or indexed universal life for the insurance vessel within the retirement plan. These insurance vessels do not provide the types of various guarantees needed to complete the success of the pension plan. Also, whole life insurance has provided an annual cash dividend payment for over the past 100 years from some of the top whole life companies. Okay, let's take a look at this chart on a retirement plan investment choices. Let's say if you have a 45-year-old with an annual contribution of $56,000 per year into his profit sharing plan, currently has $225,000 saved up. So we have our two choices. We have our whole life insurance and our mutual fund portfolio. Let's say the mutual fund's in a balanced fund, dividend paying fund. 49.9% of our annual contribution goes to the whole life policy, 50.1% to the mutual fund portfolio. So we have a blended rate here of 5%. That's because we have the guaranteed interest and the dividends from the whole life policy and the 5% balanced return on the balanced mutual fund portfolio. So you can see here at age 45, we're at $295. At age 61, $2 million, okay, by earning 5% a year every year. But we have this incidental death benefit of $1.8 million from the whole life policy that, if you learned from before, from taxes in a qualified plan that the beneficiary has to pay, we're going to provide the death benefit or the money to pay off that tremendous tax burden. Okay. Now over here in the second column, we're in a mutual fund portfolio, 100% growth. As you can see here, we have 3 down years. Okay, because we can't guarantee what's going to happen in a mutual fund. We could have a 22% return, and at age 51, we can have a 2% return at age 57. But in 3 years, minus 12, minus 10, and a minus 25, and this has happened before. These huge decreases. But look what happens here. Our accumulated value at age 61, or in 16 years, is 1.7 million compared to 2 million. So it makes a lot of sense when you really crunch the numbers and look at a pension plan design to include this whole life insurance into your pension plan. Just makes a lot of sense. Okay, let's talk about the different types of corporate retirement plans and the 2019 contribution limits. Okay, we have a 401k that's a defined contribution plan, contribution limit of $19,000, but if you're 50 and above, you can add a $6,000 contribution. It's called a catch-up provision. This is elective deferral. Now you have a max life insurance contribution that you can make in your 401k of $12,250. That's going to provide an approximate death benefit of $1 million if you utilize the whole life option in your 401k. Simple 401k, the max is $13,000 with a $3,000 catch-up provision. Max life insurance contribution there is $7,800 with a $500,000 approximate death benefit. 403b, that's for schools and churches. You have to make sure that you could purchase life insurance in a qualified plan in a 403b, because many plan documents don't allow that option. So it's $19,000 with a $6,000 catch-up provision. Okay. IRAs, max you can do an IRA, personal IRA is $6,000 with a $1,000 catch-up provision. You cannot buy life insurance in a individual IRA account, so we can't do that. The SEP, Simplified Employee Pension Plan, was $56,000. We use that as our example from before, okay, with a max life insurance contribution of $27,440, or approximate death benefit of $2.2 million. We have a 457 elective deferral. That's another type of defined contribution plan of $19,000 with a max life of $9,300, and the money purchase plan is $56,000 and $27,440 max life contribution, approximate death benefit of $2.2 million. Okay, let's take a look at a traditional company pension plan, a simplified employee pension plan, or a SEP, where we have 2 owners, 55-48, office manager making $95,000, nurse making $75,000, another nurse making $75,000, billing specialist making $45,000, and just general help making $25,000, and 2 owners making $350,000 apiece. And they're making a 25% employer contribution. So max contributions would be $56,000 for each owner, Then we have 23,000, quite a bit of money for the office manager. 18,750 for the 2 nurses. 11,250 for the billing specialist, and the general help is 6,200. So the problem here is that the owners have to put a tremendous amount of money away for the employees on an annual basis, $78,000, almost $80,000 a year. So this a lot of times is not attractive because too much money is going towards the employees. Okay, now let's take a look at an example of a pension plan design for the benefit of the owners of the company, because that's the whole purpose, is to provide the maximum benefits, pension benefits, to owners of companies. Okay, but we just can't give the owners all the money. We also have to give some to the employees because of IRS non-discrimination rules. So we have a bunch of rules here stating that we cannot discriminate in favor of the owners of a company, highly compensated employees, but really the owners of the company, and not provide anything to the workers or the employees of the company. So here's something we're going to go in detail. It's a 401k safe harbor. I'll explain everything. And cash balance defined benefit plan. A very complicated design here if you're not familiar with it, but after I go through it, it's going to be a lot easier for you to understand. Okay, so we got the same census, same groups: owners, office manager, nurse, billing specialist, help. Total annual income of $1 million between everybody. So we have owner 1, owner 2. Their effective tax rates are 36%. So look what we're going to do here. This owner, we could have 95% of his current annual income going towards a pension plan, okay, based on all these different mathematical calculations, okay. And he's 55 to 48-year-old. We could have 73% of his income going towards a pension plan. Office managers, you can see here, lower amounts. But at the end of the day, the employee contribution made by the employer, so we were able to design a plan here where $30,000 a year goes towards the pension plan instead of that larger amount, okay, of $78,000 right here. Okay, so we're at $30,000 for the employees. Some of the majority of money is going towards the owners. Okay, so let's really break this down. So we have, when you have a pension plan, you could have multiple different types of pension plans. You could have a defined contribution, 401k, profit sharing, and you could have a defined benefit. And that's what we did right here, the way we did this. So what we do, we have an age-weighted profit sharing plan. And I'm going to go over all this in detail in the math part of our explanation here. But just to summarize, so the age-weighted profit sharing plan, we're doing the maximum contribution of $56,000 for owner 1, $56,000 for owner 2, and we're going to go over these calculations in a little bit for the employees: $6,000 office manager, $2,000 nurse, $3,000 nurse, and the lower paid employees were able to put in $700 and $350 a year. We want to minimize that. Then we have something here called a 401k safe harbor contribution. All that means is to keep the plan from being discriminatory, we have to utilize a plan called Safe Harbor 401k, and all that means is that we're taking 3% of the employee's annual income and we're going to put it into this Safe Harbor plan. Okay, so that's going to save us from having a discriminatory pension plan. It's very important. Okay, so you can't get away with putting no money towards your employees, but as you can see here, it's going to make a lot of sense. Okay, now we're going to have the cash balance plan. So in the cash balance plan or the defined benefit plan, we could put $275,000 in towards owner number 1, the 55-year-old, $200,000 for owner 2, the 48, then these amounts here for the employees. Now the thing is, you're going to state, well, this owner, 55 years old, he's making $350, and we could really put 95% of that amount into a pension plan. How's he going to live? Well, this is a great plan for business owners that let's say they have wealth outside of their, or tremendous savings outside of their income that they could live off of, and their whole goal is saying, hey, listen, I don't need my current income. My wife or my spouse works. I have other investments such as private placement investments, real estate investments, other business interests that pay for their living expenses. So the money I make here in this scenario, yeah, sure, I could put 95% of it away if you could show me how to. And that's what we did. So by doing that, by deferring most of his income, 95% of it, we're dropping his tax rate from 36% to 28%. His annual income from 350 to a taxable income of 75,000. So in this scenario, we can literally save $100,000 a year in taxes, okay, for the 55-year-old. And owner 2 in this scenario, 84,000. So that's just the gist of it. With a properly designed pension plan, and depending on the needs of your client or prospect, the business owner, we can really provide a great tax shelter, provide tremendous funds for their retirement, and with the minimum contribution to their employees. Okay, now we're going to dig into this and go over the calculations, the secret formula for the age-weighted profit sharing plan to show you how this works. Okay, so this is how the IRS wants you to calculate the proper benefit for an employee. So what they want, the IRS wants you to provide an annual pension at retirement of 10% of the current compensation. So we're going to take that 25-year-old who has $25,000 a year in current income. So at 65, 10% of 25,000 is 2,500. So we have to provide $2,500 a year for life expectancy. Okay, person might live longer, but our calculation is going to be based on what we have to contribute based on IRS tables of life expectancy, which is 87. Okay, so we do $2,500 a year for 22 years. So we're going to take the present value of that $2,500 a year for 22 years, okay? And we're going to discount it at 3%. Then you get a present value calculation. And that number is $41,109. So what we need to do is figure out how much we have to put away in our profit sharing plan for this 25-year-old who's going to retire at 65. So it's 40 years. So we have to save a amount of money for 40 years so we can get this $41,000 of money 40 years from now. So when we do that calculation, it comes out to $350 a year. So that's the beauty around an age-weighted profit sharing plan. If you have younger employees with lower incomes and you're upset because you have to contribute to a pension plan for them, well, don't be upset, because the amount you have to contribute is going to be very nominal in comparison to what you could put in for yourself. Okay, and like we showed you on the previous example, your tax savings on an annual basis. So this is a really good deal. So that's why we want to utilize this age-weighted profit sharing plan within the total scope of your pension design.